Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. Today we're looking at whether the US equity market can continue its remarkable tech-fueled run, or whether it's now time to look at hard assets such as commodities. Last year, the major US indices made double-digit gains, with the Nasdaq 100 up 20% and the S&P 500 gaining about 16%. And this was despite the taper tantrum wobble back in April. This rally was largely fueled by the ongoing craze for tech stocks, and particularly AI. Now that tech stocks have had a great run, many investors are getting nervous and are worrying that the current market setup is similar to that of the dot-com bubble and crash of 1998 to 2003. In fact, Deutsche Bank reports that 57% of respondents in their Asset Manager Insight survey thought that a plunge in tech valuations was the biggest threat to the markets in 2026. Cautious investors have been trimming and hedging their positions, but as you'll already be aware, it's rare that a consensus view actually becomes reality. You see, if everyone is already positioned for a bearish outcome, then it becomes harder for that outcome to actually materialize. And furthermore, many of the comparisons with the dot-com era are not comparing apples with apples. And that's because the final throes of the dot-com boom were fueled by debt, which had been boosted by lower interest rates that were cut for a number of reasons, such as the emerging market crisis, the threat to financial stability caused by the implosion of a hedge fund, plus concerns that the transition into the year 2000 could suck liquidity out of the system. Back then, rates remained too low for too long, and markets parted like it was 1999, forcing rates to rise rapidly again. Today, however, the investment in AI has not been fueled by debt, but financed by cash. US corporate cash flow has been rising rapidly in recent years, and this trend has been dominated by big tech such as Apple, who've been deploying that cash as capex. Yes, markets are stretched today, and they are pushing the upper boundary of historical valuations, but sentiment is not at extremes. If anything, there is still the possibility of lower interest rates ahead, more liquidity, and the potential for a future debt-fueled blow-off top. But some investors are taking a cautious approach to tech by switching into one of the other sectors that performed really well in 2025, which is the commodity sector, and in particular, metals. Silver, gold, and copper are all close to all-time highs. In fact, the current economic setup is a great backdrop for the types of hard assets that can be a useful hedge against inflation, which is one of the main factors that could eventually derail the tech train.